Hey everybody, how are we doing? Welcome back to another ITPM webinar. Can we get a shout out of your location, please, in the Q&A? So you should see a Q&A area on the right-hand side. Okay, wow. A waterfall of locations, beautiful. Nice. Everyone can hear me okay, right? Many familiar names here, fantastic. Okay, we're gonna have some fun today, guys. Relaxed event, Q&A, ask me anything session. Okay, so let's get started with this AMA, guys. I've looked through all of your questions that you sent prior to the webinar. And I've put them into 8 categories, okay? Of course, they don't all fit into every one of those categories, but they pretty much do, the vast majority. So firstly, general and answerable. 2, unconscious. 3, nugget hunting. 4, to do with ITPM strategy, how we actually trade. 5, ITPM admin. 6, alumni. So what I've got to do here, guys, if you're alumni and you're on today and you've asked questions about like content in the online programs, what do you do here, what do you do there, that's not for today, okay? This is a public AMA. Alumni, if you're asking questions regarding that type of stuff, you need to ask those questions in the Discord servers, okay? Number 7, finance career. And number 8, a lot of you are asking about artificial intelligence, AI, how it fits into trading. There's lots of questions to do with that, obviously, because it's very topical right now. Okay, so you can ask questions, obviously, in the live Q&A area. I'll try to answer them as many as I can. Because we've only got like limited time, obviously, if you're asking questions that I just cannot answer, or I don't want to answer because it might take up too much time, right? And then the quality of the question, when I'm answering them out loud, obviously the quality of the question matters because it needs to be useful for other people who are listening, okay? So you can obviously ask questions in the Q&A, of course, Q&A area on the right-hand side. But I'm obviously not going to be able to answer every single question today. I'll try as much as I can to cover as many good questions as I can, okay? Right, so here's what we're going to do first. Let's have a little bit of fun, right? Let's go to unconscious. Does everyone understand what I mean by unconscious questions? If you don't know what it means, then shout in the Q&A and I'll cover it. But basically, unconscious means, okay, so we have like a hierarchy of consciousness when it comes to any skill set, whether it's driving a car, playing chess, playing a sport, whatever, okay? Basically, the bottom of the pyramid is unconsciously incompetent. Basically, what it means is that you're so new to something, you don't even know what you don't know. So you're basically unconscious and incompetent, okay? Then the next level is conscious incompetence. So basically, you are aware of what you don't know, but you haven't really done anything about it yet, okay? Then the next level is consciously competent. Consciously competent. So now you're competent, you've got skills, you know what you're doing, but you need to practice, okay? And then the top is basically professional standard, okay, in any skill set, including trading, right? So it's unconsciously competent. You do it with your eyes closed without thinking about it. Now, what's at the bottom of the competency hierarchy for trading? It's basically retail individuals that have no idea how financial markets really work, but they think they do because they've been given messages. Maybe you watch mainstream media, you get told things that aren't true, you believe things that aren't true. So for example, like, okay, this is what a trader does, and that person has a conflict of interest. So now you think that's what traders do. So then you make all those assumptions before you even ask a question. So stuff like this, right? So let's go through these. And, this is not to pick on anyone, by the way. Everything we do as a school is in the spirit of educating, okay? What I'm trying to do here when I go through stuff like this is to show everyone on the webinar the messages and the understanding of trading that is just wrong, okay? And you should learn something from this, okay? This is why we're here today, to learn from all of these questions in the AMA, okay? So let's start at the top here. What is the best industry in which a young entrepreneur in the mid-20s can make 25 to 50K, so then you can start trading after? Okay, dude, you are literally asking me how to make money doing anything. Okay, I read that and I was like, start an OnlyFans. I don't fucking know. Like, do anything to make money. Like, if you need to, right? Can I start with less than 15 to 25K if I'm not using options for trading? So you're basically trying to argue with what we always say in order to do this properly, which is you've got to have a minimum amount of money to do things, right? It's an unconscious question because you're just arguing with the facts of reality. You need a certain amount of money to trade to do it properly. We're not lying to you. And if you're looking for shortcuts, it's an unconscious way because you actually think that there is a shortcut, okay? How much time is optimal to achieve financial success as an entrepreneur? I mean, that's such an unconscious question, right? Because you're basically just saying, in business, how much time do I need to make money and become successful? How long's a piece of string? And also a long short portfolio manager. I mean, that's not an unconscious question, but that is more a timing in terms of like, how do you become unconsciously competent at trading? It's going to take a year to 18 months. Okay. Right. Next one. And I've taken second names out, by the way, because I'm not embarrassing anyone. Next one. Buying calls with 90 to 100 days till expiry. Okay. So what happened to puts? You just in call options. What happened to put options? Okay. Unconscious. Okay. Buying call options with 90 to 100 day till expiry on growth stocks with average volume higher than 5 million. Is this viable long term? That's unconscious because you're making the assumption that volume is important for you as a strategy to buy call options. Of course it isn't. It's not at all. No one cares. Gerard, what are the key indicators to look for when you're looking for an up and coming company to invest in, e.g. long Palantir? So that's unconscious because you actually think there's like a few indicators that you need to look at, and then you'll know what's going to be the next big stock to buy, right? Of course not. There's a lot more work that needs to be done than that. Hi, Anton. Is dark pool data reliable for 60 days? What's the way you trade? I think you're asking. And I use technical analysis that scan institutional exhaustion and momentum failures on multiple time frame. Okay, listen, like none of this is going to make you money. Okay, so again, this is the unconscious approach. Like you actually think dark pool data. You're asking if it's reliable, which means you're assuming that dark pool data is somehow useful for retail traders. It's not. It's completely useless. I use technical analysis that scans institutional exhaustion and momentum failures on multiple timeframes. Useless. Like if an institution is doing something and you're guessing what they're doing, that's not a trading strategy. Okay. So again, it's unconscious because you actually believe it is for some reason. Like your belief is embedded in that question. Next one. What role does the order book play? None. I've not looked at an order book since I was a professional trader at JP Morgan. Right? It's like it's completely useless. Like if I'm deciding whether to go long or short a stock, the order book doesn't mean anything. It just literally doesn't mean anything. Why would I like if a stock is like $50.65 on the bid and it's $50.66 on the offer? Why would I care if there's a guy offering stock at $53.74? Why would I care if that there's a guy bidding $49.75 for stock? So if I go down the order book and I see that there's someone there, it makes no difference at all to whether I buy or short that stock. Okay. So you, again, this is unconscious because you actually believe this is something that matters, right? And this is one of the problems with retail trading is that you get fed so much bullshit and nonsense on the internet these days that you end up bumping into something that sounds plausible and sounds reasonable, and then you build years of strategy around it, and it's all completely useless. So what happens is that you end up just circling around at the bottom of the pyramid, being unconsciously incompetent. And this is like exactly what I'm talking about. Next, if I'm 1 month into a 4-month trade expiry and already 60% up, do you think it's best to set up a stop loss or wait for further catalysts? Okay, so what you're basically doing here, this is a massive retail trader error. Okay, you're looking for a rule from one specific situation that you've encountered, and then you're going to take that rule and then apply it to everything else for the rest of your life. Trading doesn't work like that. So essentially what you're doing is you're adding 2 and 2 and getting 5, which is you're trying to take a rule from one specific situation, then apply it to all situations throughout time. That's not how it works. So you're looking for a rule book. You're looking for a rule book. A rule book implies that something is going to work every time, or it's like a guarantee or a shortcut. It doesn't happen in financial markets. Okay, you need to be flexible. Joseph, do you trade short term? Basically, he's asking me if I'm a scalper. No, of course not. You can go online and like watch 5-10 minutes of our YouTube channel and realize that we're not scalpers. Okay. What's your take on selling options or running the wheel strategy in the long run? Complete nonsense. That's not a trading strategy. Okay. So the basics of a wheel strategy, if I'm remembering correctly, is to sell cash secured puts. And then if your puts are in the money, you take delivery of the stock and then sell a call option to put on a covered call position. That can just go wrong massively very quickly, right? Because you're basically selling puts usually in stocks out the money, and you've got no fucking idea why you're actually looking to sell puts in that stock. And then when you actually end up long the stock, you then write a covered call, and if the stock just keeps going down, you lose a shitload of money. It's a really stupid thing to do. What is the best trading approach for those who have less than $500 to trade with? Give up, make some money and come back. $500 is a ridiculous amount of money to start trading with. It's just gambling. So again, this is all unconscious stuff, right? It's like this guy, Karim, he's been told that this is a good strategy, but he can't figure out that it's not a good strategy because the reward to risk is just terrible. What is the best trading approach for those who have less than $500? Yeah, this guy thinks you can actually trade with less than $500. Otherwise, he wouldn't ask the question. So very unconscious. Can you still day trade even if you're running a 1 to 3 month long short portfolio? Yeah, you can, but it won't work over time. Again, asking the question, thinking that day trading is a viable strategy for him because he's been told a million times that it is. It's not. Do the IPLT video series with us. You'll realize we prove it statistically that it's not. Okay. I think this guy is asking about prop trading firms. There was a few questions about prop firms. Guys, they're all a fucking scam. Okay. You do your little stupid gay challenge on the fucking website, right? And you can take it as many times as you want and pay them as many times as you want to take the challenge. And then you can pass the challenge on attempt 24. Okay. Does that make you somebody who's got the ability to trade? Obviously not. Then you trade a fund, what they call a funded account, but the money isn't fucking real. It's a fictional number on the screen. It's a demo account. Okay. And then people wonder when they become the 1 in 300 guys that actually make some money from that demo account, why they don't get paid out. Because the money isn't even real. It's a scam. Okay. Again, very unconscious. What's the best platform to trade, and is it user friendly? Again, unconscious. One, he thinks that the platform is going to make you a good trader, and that if it's more user friendly than not user friendly, it's going to make you an even better trader than that. That's retarded. Like, of course not. Like, the platform isn't going to make you a good trader, and the platform being user friendly or slightly unuser friendly isn't going to improve your ability to trade. Okay. The platform is just for execution. You just need to use it to buy and sell. Why is it important for a retail trader to have some money? Fuck me. Why is it important if I throw you in a swimming pool to have some arms and legs? Because you need to swim. Okay. Why is it important for a retail trader to have some money in order to start trading? Also, do you approve demo account for the first month? Listen, demo accounts aren't going to help you become a good trader. I think here you're basically just asking, can I use it to just like learn the platform to like place a trade? Yes, learn how to place a trade. That is like less than 1% of what you need to learn. Okay. Retail traders worry about the things that really don't matter, right? It's not whether you can buy and sell something. It's whether you should or not, right? It's like you got to figure out how to become good at knowing what to buy and sell, not whether you can. Just because you have access doesn't mean you're good. Okay. Again, it's 2 + 2 = 5. Olga, how to know that a company stock is going to go up or down after a long downside or upside movement? I mean, again, this is like looking for a rule where you just grab some indicator and say, I'm just going to use that indicator when a stock goes down, and then I'm going to know if it's going to go up. In every situation, forever. It doesn't exist. It doesn't exist. But obviously embedded in that question is a belief or assumption that it must exist. It doesn't exist. Is Seeking Alpha a good source for idea generation? Okay, that's a problem question, unconscious, because you assume that copy trading is the way forward, is a viable strategy for retail traders. So you're just going to go on a website, there's going to be some ideas there, and you just copy them, put the trades on, make loads of money, and then retire with multi-millions of dollars. No, not going to happen. Can you make money day trading with leverage prop firms? No, they're scams. And also day trading is a joke, right? Like I don't care what anyone says. I know the success rates of day traders over time. Why would you play a game where it's 99% against you? 99% odds against you guys. Are we able to tell if the market is heated just by looking at the SPY? No. What's the best route to join the financial markets? Is it Forex or options trading? Again, that's an unconscious question because you just think it's one or the other, right? There's many ways into financial markets professionally, okay? How can I scale up my trading? Make loads of money. That's how you scale up your trading. How to gain 66% in a year. Not 67, not 65, not 77, not 75, but exactly 66. Fucking hell. Hey, Anton, do trading sessions work when trading gold? Gold, I believe gold is one of the most traded commodity, and according to my chart observations, it looks like gold has high volume. Okay, again, we're equating volume with success. Volume and success are not the same thing, right? You don't get success because something trades a lot of volume. That's the wrong way to think about financial markets. How do we hedge against Trump ever changing a decision? Unconscious, you can't. How much of your portfolio is invested in AI stocks? You're on the wrong webinar, dude. I'm not an investor. I'm a trader. How to find profitable stocks and where to invest? Again, we don't invest. Investing and trading is very different. For some reason, retail traders confuse the two. They think investing and trading is the same. It's not. How to think wisely about the defense sector investments globally 1 to 3 years forward? Again, you're on the wrong webinar. Okay, so there's always one guy that comes in to webinars like this and then defends day trading. So there's a guy here who says, Anton, I'm surprised that you say day trading doesn't work. Why? It's proven statistically not to fucking work. How can you be surprised about somebody throwing facts in your face? Okay. And then he says, when I know lots of successful day traders with a proven track record, okay, I'm going to give you the benefit of the doubt that you know some. So what? I don't care. Just because you can point to one person or 3 people that you know have made some money day trading over a specific period doesn't mean that day trading works overall. You do understand the statistics, right? It's a 99% failure rate. Why would you play that game? It's fucking dumb. It's completely dumb. Then to defend it by saying, I know one guy that does it well. So what? So what? It's not a solution for retail traders. Okay, retail traders don't trade full time. They're not sitting in front of their screens all day. And even if they were, they still have a 99% failure rate. So what's your fucking point? I know one guy. I know 3 guys. I'll give you the benefit of the doubt that maybe you do. So what? Come back to me with a response. I want to see the response. If it was viable, I would be doing it myself. Of course I would. Right, next. What percentage of candidates that join the course, I think that's supposed to say consistently make money 1 year later? Okay, I've put that in unconscious because I know what this guy, he's trying to get an answer where, let's say I say 60% of our guys who do programs, a year later we check in on them and they're making money, right? He would think that means a couple of things. One, he would think that means we have a 60% success rate. No, it doesn't. It doesn't, because we can check in with them after 8 months and it can be 70%. We can check in with them after 18 months and it's 50%, right? It goes up and down, it oscillates. Also, he thinks that there's no drop off for some reason. So, we are public facing with retail traders, right, as a school, which means if we take in, say, 40 traders on a mentoring program, you check in 1 year later, how many out of the 40 do you think are still trading? Exactly, right? So there's different ways of looking at it. You can look at it as the guys who continue, if they decide to continue up to 1 year, what percentage are making money? The guys who continue, the percentage is very high. The other thing that this question asks, and this is always where the unconscious element comes in to this question, is he thinks that number means that it's his percentage probability of making money or not after 1 year. Obviously it isn't, because you could just be really dumb. You could just be really lazy. and do no work. If you're really dumb and really lazy and you come to ITPM, it will be very difficult for you to succeed. And then will you still be around after 1 year? Probably not. So you can't equate that number. If that's what you're getting at, this is usually why people ask this question. They think that's their probability of success. Again, you're adding 2 and 2 and getting 5. It's not for your personal situation. It doesn't have any bearing on your own personal situation. But generally speaking, if you're quite smart, you do a decent amount of work, and you keep working hard over 1 year, it's actually very, very difficult to fuck it up. It's difficult to mess it up. Okay. Yep. Again. Okay. So this guy's come back again with the day trading. This is what they always say. I mean, you might as well go to the fucking day trading textbook answer to everything, right? I understand what you were saying from a retail trader perspective. They don't sit in front of the computer all day and they have a job. Yes, dude. Even the guys that do, the success rate is tiny. It's 99% failure rate, even if they do. And then he's saying, but if you're a full-time trader, if you have an edge, there's no edge. This is one of the biggest lies of day trading. There is no edge as a human in day trading anymore. Okay. Check in the 1980s and 1990s, maybe. There's been no edge since the 2000s. It's a lie. You don't have any edge. Okay. The fact that you've said that makes me know 100% that you have no idea what you're talking about. Come on. Yeah, someone's asking, like, why are you arguing with a guy who thinks day trading is viable? I need to do this out loud so you guys understand. So everyone on the Q&A AMA today listens and understands. Okay. Okay. Next, Jahid. No formal higher education, but I'm financially literate and I manage a £5,000 trading account and hold £15,000 in Bitcoin. Okay. Someone tell me in the Q&A area why that's an unconscious question. I'd like to hear your thoughts. We won't spend too much time here. We're nearly done. Then we'll move on to other stuff. Okay. Someone said not enough money. Someone said he thinks £5,000 is enough. LOL, Bitcoin, no process or view. It's too specific. Okay, let me tell you what a professional trader thinks of this question. I have no formal higher education. And then he makes the claim that he's financially literate. Okay. Then in the same sentence, he says he's managing £5,000. How can you claim to be financially literate if you're managing £5,000? That's crazy. Okay. Trading index CFDs. Okay. I mean, index CFDs, you're going to be like on leverage 8 to 10 times, something like this, and £15,000 in Bitcoin. I've got news for you. Unfortunately, I'm just going to be very honest. Okay. You are not financially literate. Please. Now, I know at the end here, he's asking, do I continue in this manner or pursue an education? You need to pursue a proper education to become financially literate. Okay. Because you're nowhere near where you need to be able to claim that you're financially literate. Okay. Is the VIX behaving correctly lately? Why would you think that there's times when it doesn't behave correctly? Again, unconscious. It's just assume that it's correct all the time. And then you have no edge over, as a trader, you have no edge over deciding whether the entire S&P 500 is priced incorrectly or wrong, and volatility of the S&P 500 is priced incorrectly. Just think how absurd that is, right? A retail trader sitting in their basement at home somewhere in the world decides that the S&P 500 VIX is priced incorrectly. That's mental. That's mental. Okay. Last one before we move on. I've heard you say you should not trade for income because it makes you take on excessive risk. But separately, I've also heard you say that if you are trading an account of $1 million, that you should do it full time. No, you've misheard me. You've misheard. I'll be more specific. So is it that you should not trade full time? Okay, so basically, when you trade in the way that we trade, which is probably one of the most optimal ways a retail trader should trade, okay, you definitely need to have a day job and an income coming in from that day job up until between $1 million and $2 million. So this is not static, it's dynamic, right? We live in a dynamic world, okay? So let's say, for example, you put 100 grand in a trading account at ITPM. In your first year, you make 150 grand, your account goes to 250, you put in another 50 or 100, you grow it in year 2 to like 700, and then year 3, you're going through 1 million, okay? Now, you're not just going to close all your positions when you get to 1 million and then go and see your boss and say, I quit. That's what people think is what people do, right? You don't. Obviously, it's dynamic, right? Somewhere between 1 million and 2 million, you can quit your job knowing that you're actually very good at what you're doing. But there's a condition. You should have another income stream coming in. So whether that's, you've got an apartment that you rent out for $4,000 a month or whatever, you've got some sort of income coming in, passive, that you don't need to worry about your day-to-day living expenses, okay? Because you don't want to take money out of your account if you don't have to pay for bills, okay? You don't want to be paying your mortgage from your trading account. You don't want to be paying your car payments. You don't want to be paying your kids' education, private school, whatever it is, from your trading account. All of that is just stupid, right? Don't pay your medical insurance from your trading account. All your big expenses, utilities every month, all your big expenses need to be taken care of, okay? So, unconscious questions. We have to go through them, guys. I'm sorry. I apologize, but we have to go through them, okay? Because it's very important for retail traders to see this stuff, to understand that there's a wrong approach to thinking and there's a wrong approach to doing things in financial markets, okay? And there's reasons why, and it's not always your fault. There's a lot of media and brainwashing and bullshit out there. If you've got a full-time job, you run a business, you've got a family, you've got hobbies and interests, there's only so many hours in a week, and in those hours per week that you have off, okay, you're putting on media that is selling you nonsense when it comes to financial markets and trading, okay? There's a lot of conflict of interest around, and a lot of it is bullshit, okay? Like the day trading one is a classic example. It hasn't worked for 20 years. 20 years, okay? It's been on the decline as a profession, right? Within financial markets, being a professional day trader, it's been on the decline for 20 years, okay? And people still believe now that it works, that it's a viable strategy. Now, if you've got a ridiculous quantum model and your Renaissance technologies, then yeah, like scalp away to your heart's content, 20,000 trades a minute, beautiful, right? But you can't compete with that as a human, especially if you're retail. Even if you're a pro sitting in like a trading room somewhere. The turnover is huge. It's huge. Okay. So someone might have a good patch for like 6 months, a year, then they'll do nothing for years and they'll just struggle for years, right? And then they might have a good patch again. Just because they had a good patch doesn't mean long term it's a viable strategy. Okay. Good strategies stand the test of time and they make money in all different markets. Okay. Let's have a look at strategy. And let's go from the bottom. Let's go from the bottom. So how to maximize wins and minimize losses in the long run. Well, so what we're doing here, guys, we're looking at, I put this in strategy as a category because really it's answered through the lens of ITPM strategy. Okay. So how to maximize wins and minimize losses in the long run. Well, the answer to this really is to have reward to risk skewed in your favor. Okay, so it's really a preventative risk management approach. Okay, so the best answer to that question is options. Okay, so you have asymmetric reward to risk. So your risk is just the premium you pay, but you can make significantly more on the upside than if you had the same position in a stock, right? So when you swap a stock position for, say, a call option or a put option position, the downside is defined like you have in a stock. Okay. So if you buy a stock and it goes to zero, you know how much you can lose, right? It's just whatever you bet. Well, it's the same in an option. The downside is the same 100%. Okay. But your upside is far greater for the same amount of dollars because you're getting leverage on the upside of that call option. Okay. Now think of a put option. Your put option is downside 100%, but if you were short a stock, your downside is infinity. Okay. So you're now flipping the reward to risk metrics. So if you're short a stock, your downside is infinity and your reward is 100%. With a put option, your downside is 100% and your upside is not infinity, but it's a huge amount of money potentially for the same amount of dollars that you would short a stock. Okay. So what you're doing is you're introducing asymmetric reward to risk into your strategy. Okay. And that's why we trade options. That's the beauty of options. Okay. So when you ask the question like how to maximize wins and minimize losses in the long run, preventative risk management, and it's built into the structures of the options that you trade. And it's built into options full stop, right? Let's see here. Next one. This is a long question. My primary goal is to protect my capital. Yes, that's everyone's primary goal. Could you tell me what kind of structure, procedure, or guidelines you would suggest for someone like me in order to develop a methodical plan that strikes a balance between steady growth and moderate risk exposure? Well, yeah, I mean, what we do as ITPM in terms of strategy, long short equity options portfolio management, 20 to 60-day time horizon, diversified portfolios. So your downside, because we're using options and we're very diversified, is very, very small, and your upside is explosive. And all you have to do is learn how to manage that risk and come up with good trade ideas. It takes time, but the growth is incredible. When you know how to do it, you've seen the numbers from the Thailand guys. How to build a solid trading plan with trading data sources. I mean, our two online programs, PTM video series and POTM, that's your trading plan. That's a very solid trading process. It's like step by step by step by step all the way through. How to find the best shorts in a bull market. I mean, this is an ITPM strategy question because we literally teach you how to do that. So it's the fundamental approach. Okay. What you're typically looking for is X growth situations in a bull market. So for example, like right now, I think Jason is going to do a flash episode on this coming up very soon. Looking at, if you look at, for example, software as a service, SaaS stocks, the whole sector got pretty hit hard in the first couple of weeks of August. If you look at the bellwether, CRM, Salesforce, it's basically flat now since 2020. So the stock hasn't gone up in 5 years. Okay, it's in what we would call phase one of going X growth. So if you go through the ITP, it's basically fundamentally driven. Okay, I should be back. Hold on. Yeah, I think my internet froze for a second, but I should be back. Am I back? Okay, back. Yeah, if it goes off again, guys, it'll just be a pause for a second. And if I have to leave the room, then I'll just come back in. So don't worry. If there's a tech problem, I'll come back into the room. Relax. It's just when you're flying solo, sometimes these things happen, right? Okay, so people are asking, repeat the last 20 seconds. Okay, so we're talking about CRM, Salesforce, okay? Phase one is basically, if you look at a 21-year chart of Salesforce, it goes like this, right? And then the last 5 years, it's gone sideways like this, up and down, up and down. And then it's just breaking to the downside now, okay? Now, the reason it's doing that is not because of technicals, right? You don't look at a chart and go, oh, look, it's breaking. That means I should be short. No, like that's not how you generate a trade idea. The chart is simply the pictorial illustration of the fundamentals, okay? So the fundamentals are driving the price, okay? And when a stock has earnings growth and revenue growth like this for a very long time, and then that growth tails off, you have what we call a phase one drop, where basically institutional money starts coming out and rotating into areas of the market where the growth is at the beginning phases or the middle phases, not the end phase. Okay. So SaaS is going through CRM. It looks like it's going through the end phase of their growth. And it's all to do with AI, right? Because basically they're investing a lot of money in AI agents for their clients, which is counterintuitive because they're firing people themselves. They're reducing headcount. Their revenue growth has slowed down a lot. Earnings growth has slowed down. They're investing in AI agents. So they're asking their clients to do the opposite of what they're doing, right? Don't invest in AI agents and don't reduce your headcount. Well, obviously not. They're going to do what they're doing, right? So it's not looking good for software as a service. So these companies, they are AI. If they invest in AI, they're just cannibalizing their own businesses, right? So if they invest in AI agents and give them to their own clients as part of their Salesforce offering and their product, what does it mean? Well, it just means the guys themselves can just build their own AI agents internally and reduce their headcount. They'll just do exactly the same as what CRM have done. So they're putting a brave face on it, and they're investing billions in AI agents because they've got no choice. It's a desperate move. But longer term, this is not good for software as a service and CRM as the bellwether. So yeah, how to find the best shorts in a bull market? Look for X growth. But you've got to know what you're looking for, right? So this is why it's so important to get educated. How best to manage risk in a volatile market? Diversified portfolio, own lots of put options. So you got lots of long ideas, you got lots of short ideas. So what's quite interesting? The last phone call I did with my students on my mentoring program last weekend on the Thailand program, there was a number of them that didn't have enough put options. So we looked at, for example, a slightly out of the money hedge using the Russell 2000 IWM. Okay. and we found one that paid us 7 to 1. We found a vertical spread in January that paid us 7 to 1. So a bunch of them put it on. Okay. So, next question as well, like how to play possible incoming risk off market. Again, like our job as traders, so long short equity options portfolio managers, it's not to be dogmatic and to be all one way. So if we're bullish, we're not thinking to ourselves, let's just buy lots of call options and go long. That's not how it works. We don't think that way, right? Let me tell you how we think. We think, okay, do I have enough puts in my account where if the market went down when I didn't expect it to, that I own puts in the right stuff where when the market goes down, they go down a lot and I make a lot of money when the market goes down? Do I have that exposure in my account or not? And if I don't, why not? I should have, right? And I'll tell you why. Because if you want to be bullish, as a risk manager, as a responsible custodian of capital, as a portfolio manager of your own money or someone else's money, okay, you are not allowed to be bullish unless you have protection. If you have enough puts in your account, then you have full permission to be bullish. Do you understand how that works? If you don't have protection, you have no right to be bullish. That should make sense to people. Because if, for example, you own lots of put options and lots of call options and you're bullish and the market goes up a lot and you have to write off your put options, guess what? The downside on your put options is 1, but the upside on your call options is 2, 3, 4, right? That's how it works. But if you're long lots of call options and you don't have any protection, and then the market just goes down 5, 10, 15%, like it did in April with the tariff week, okay? If that's the situation, what do you think is going to happen to all your call options? They all end up out of the money, and all your call options are a write-off. So then your account takes a massive hit, okay? And then you're in what would be considered an irrecoverable position, an irrecoverable situation, okay? So yeah, these questions here, best way of hedging in market pullbacks. This is why we have well diversified long short accounts, okay? Because we make money when the market goes up and on the way down. On the way up, we make more money than the market goes up because we're trading options, okay? So maybe we're writing off puts and selling out of calls, okay? And then when the market goes down, the market obviously goes down and we make money. So that's where we get a big outperformance, a big divergence. So again, look, what is the strategy for the correction? Best way of hedging pullbacks. Your best way of hedging pullbacks is not just to buy generic hedges all the time, right? You only buy generic hedges really when you've got no short ideas. And you should be good at generating short ideas if you trade the ITPM strategy. What is your exit strategy on your positions? Calm and relaxed and patient. So scaling is the normal way to exit positions. Exit winning positions, okay? Risk management for swing and position trading, how to be profitable in the long term and become a full-time professional trader. Okay, so you're getting a bit ahead of yourself there. But risk management for swing and position trading. Again, the approach of preventative risk management with options, it's embedded. The risk management is embedded into the financial instrument. How to be profitable in the long term. Good ideas, good option structuring, good risk management. I mean, I'm sure you're probably asking here this question, asking for genuine specifics where I'm going to point to like 1 or 2 things and say that's exactly how you do it. But it doesn't exist. It's a mixture of things. So maybe that's a slightly unconscious question. During your top-down and bottom-up analysis, when coming up with ideas, how far ahead do you try and predict the future? Maximum 3-4 months. Maximum. I don't try to kid myself and pretend that I know what's going to happen beyond 4 months. Can have an idea, but I think if you go out more than 6 months, it starts to become a coin flip in terms of the macro, right? It can go either way. What is most important in your weekly routine of things you need to do to stay in motion? Well, every week, and actually the guys on mentoring programs will tell you this, we go through the same process that we teach on mentoring programs, which is you're scanning through all of your positions and you're recalibrating your exit strategies on winners and your losers and how you're going to book net profits, right? So you're going through every single one and having a weekly plan. And then you're obviously exiting positions. We exit positions on a weekly basis. Sometimes on every 2 weeks. How can I figure out what trading time frames will suit me best? What are your thoughts on how trading time frames? Okay, so here's the thing, right? You're looking at this the wrong way around. You're looking at it and thinking, okay, I'm going to go into the market and tell the market what time frames suit me, and then I'm going to trade it and be profitable. If it doesn't work, then it doesn't work. Okay, so like for example, this conversation we've had on day trading and short-term trading. Why would you play that game when you know the odds are massively stacked against you for medium to long-term success? So if you say I'm suited to shorter timeframes, so I'm going to do it. Well, that's just silly, because it doesn't matter what you think you're suited to. What matters is what works. Okay. Now, saying that, if you're in this what we call the sweet spot, which is the 20 to 60 day time horizon, if you learn that first, then you can experiment later by going a little bit shorter term or a little bit longer term. But bear in mind, if you go beyond 60 days, you're now in the gray area where you're going into what we call investing. Okay. It no longer becomes trading. So I would say learn the 20 to 60 day time horizon, because that's the sweet spot. That's where the most money is consistently made. Okay. That's how you consistently take money out of the financial markets, in the 20 to 60 day time horizon. Then you can experiment with shorter term. But you're going to find that the shorter term you go, the less success rates you have. So if you start trading like 1 week swing trading, it's going to be less successful than 20 to 60 day time horizon over many trades over a long period of time. Of course, you'll have times when you make money, but that's not what matters. What matters is consistency over time. Okay. And you're going to have to work harder for those dollars, because you're going to have to show up a lot more. How can one learn and start trading with a greater success rate if you've never done it before? Yeah, you've got to start from the ground up. I mean, you're basically admitting in that question that you're what we talked about earlier, unconsciously incompetent. So like, you don't know what you don't know. So how can one learn and start trading with a great success rate? You're not going to start with a great success rate unless you're doing a fairly successful mentoring program at ITBM. And then that really doesn't count too much, because then you have to go off by yourself and do it alone. And that's really the start of your journey, right? When you go off and do it yourself alone, because this is a business of self-sustainability. You can't rely on other people to make the money for you. You have to make the money yourself. Okay. You can be taught, mentored, and learned how to do it, but ultimately you have to go off by yourself and do it properly for yourself. So when you say, how can one learn and start trading with a great success rate? You can start off well with a good mentor and obviously like a strategy that actually works, right? But then ultimately you've got to go off by yourself, and that's where your learning really starts, because then you're going to have to learn how to do it for yourself, and that is a different ball game. Okay. what it takes to be a consistent, profitable trader. Oh, many things. So it's the whole process. It's turning up consistently yourself. Consistent input equals consistent output. I would say, a good question that actually no one asked at all. A good question that we sometimes get is, what is probably the biggest reason for people failing over the medium to long term as retail traders implementing the ITPM strategy? It's not showing up. So, if I do a mentoring program with someone and then I let them go after week 12, and then they trade well for a month or two, and then something happens in their life and they stop coming up with trade ideas, they get distracted, they put less hours in. You check back 6 months later, what's happened to that guy? Well, they've deviated off the path. They've stopped showing up. They've stopped being consistent with their input, which means, unfortunately, in trading, your output becomes bad. If your input is inconsistent, your output is not consistent. Average hold time for positions taken around 20 to 25 days. How to generate a trade idea. It's in the PTM video series. We have a template and we have, I think, 12 videos that teach you exactly how to generate trade ideas. What is the best way to create wealth in options trading? And what are the necessary attributes one must possess? Okay, this is actually, for me, on the surface, this question looks so innocent, right? But it's quite deep, right? So, what is the best way to create great wealth in options trading? Okay, don't do what professional options traders want you to do. Like what I mean by professional options traders is really the market makers. Okay, what's the stupidest options trade you will ever do? Let's have a Q&A in the Q&A area. If I ask you, what do you think is the most stupid options trade you will ever do? What would you say is the answer? Yeah, so everyone got this one quite easily, right? So, okay, some people are mentioning 0 days till expiry. Yeah, that's completely retarded, of course, right? Yeah, naked shorting options. So a naked call or a naked put. Okay, that's a really stupid position. Okay, but what's the most common situation that we see? Okay, so let's say, for example, on Robinhood, what are the guys on Robinhood and Wall Street Bets? What are they all doing? What's the trade they all do, essentially? So they're buying call options, and it's mostly YOLO. Yeah, Adam's got that one, YOLO. But what does that involve? It usually involves buying something that's like fairly short dated. So maybe like a month or 2 months till expiry. And then it's way out the money, like 20% out the money or something, 20% plus out the money. So think about it like this, right? Just think, okay, a $200 stock, right? And I go and buy the 204, let's say it's now August 22nd. And I go and buy the October expiry $240 strike call for $20. My break even is 260. Okay. So I need the stock to go to 260 by October expiry to break even. But what's my 3-to-1 reward to risk? What's my 3-to-1? So I need the stock to go $80 through my strike. So you just do 20 by 4 and then add that on. You need the stock to go to $320. Okay. So for guys like us, that's just completely insane. Like we would never do that. Now, what's What's an ITPM or more sensible, more consistently profitable approach? What on that $200 stock? What would we do? Very, very different. What would we do? Let's have a guess. So yeah, Peter said at the money or close to at the money calls. That's half the story. That's half the story. So I'll tell you what we would do. We would buy maybe the December $210 strike calls. Okay, so maybe slightly out the money. But at the same time, we would short the option that the retail traders are buying. So we'd set up a calendar spread. We'd sell the October 240s to the dumb retail traders. And we do that on a ratio. So maybe we do that on a 2-for-1 ratio, where we buy 2 contracts of the December 210s and sell 1 contract of the October 240s. And we'd set up a $20 credit. And that $20 credit is very high probability. Okay. Now, in the short term, in September or October, if the stock did go to 320, we'd still make money. Why? Because we're long 2 contracts of the 210. We'd be $110 in the money on the 210s. Okay, obviously break even higher, but we'd be down $60 on the short, and we're short 1 contract. So we're long 2, short 1. If the stock just went to 320, we make money as well, right? But if the stock is below 240 by the October expiry, or 240 or below, we make $20. If the stock's 250, we make $10 on the short, right? We shorted it at 20. Okay, so we're going to get a credit. Very likely, we're going to get some sort of credit. Okay, the point is this, guys. There's 2 things going on there. Firstly, we are trading with the odds in our favor that we're going to make money. Secondly, the risk of that setup. What's happening there? We are agnostic till October. If the stock is 240 or below, guess what happens? We take the full credit. If the stock is 250, we take a half a credit. Okay, we make $10. If the stock goes to 320, we make money. Between now and the October expiry, we cannot lose money. Do you understand? We're agnostic. The stock can go up, down, sideways. It can do whatever it wants between now and October. We're going to make money in October. Now, if we have the scenario where the stock goes to 320, we trade out, we make money. If the stock is 240 or below and we get the full credit, we run the long. We've now lowered the price of the trade. We run the long. Then the stock can go up as much as it wants, right? So yeah, Aaron's saying you've essentially planned for all outcomes. Correct. So obviously there's the outcome where by December expiry, the stock is below 210. The long contracts become a write-off. But guess what? We took the credit in October, so it's cheaper than if we'd have just bought the 210s. And it's better than buying the 240s. We had a better chance of making money that whole period of time, right? So we're trading much more efficiently. Now think about it in terms of the risk. We are agnostic in that situation. When the market maker shorts that 1 contract to a retail trader for $20, the 240 strike call in October, what's the market maker doing? What do you think the market maker does when they short 1 contract of the 240s? Yeah, Peter says he laughs. Absolutely. they laugh their ass off because they think, how can people be so stupid to buy this contract? So yeah, Eric, that's one thing they can do. So Eric is saying they buy the contract back to get to neutral. Yeah, they can do that if it's still trading at the same price and they get the liquidity to do so. They would probably much rather do that. But let's say there's a whole bunch of Robinhood nut jobs that all come in at one time. Right? Let's say 1,000 guys on Robinhood come in and buy one contract each, right? Because they read something on a website, right? And they copy traded an idea. Okay. What does he do? They buy the stock. The stock's trading at 200. So they buy the stock, they short the 240 strike calls. They've got $40 as a covered call and $20 as the option credit. Okay. It's free money. Free money, guys. For the market makers, that's the easiest layup, low-hanging fruit business they will ever do. So why do you think they love Robinhood and Wall Street Bets, guys? Because it's free money. It's free money. Okay. Do you think it's a coincidence that in the last 5 years or so, this has been the predominant online push where there's an entire Reddit community of people that get sucked into doing these trades all the time? It's literally fucking financed, guys. It's financed media. Okay. It's for the morons, right? This is billions of dollars of business that gets done every month. Okay. It's free money, low hanging fruit. Now, what do you think happens to the market makers when we put a position on? So what are we doing? We're buying the 210 calls in December and we're shorting the 240 calls, the ones that the market maker would love to short to retail morons. We're shorting the 240 strike calls in October. What happens if the market maker takes the other side of that? Think of their position on the other side. What's their position on the other side? Their position is they're now short 2 calls of the 210 strike, the $210 strike calls in December, and they're long 1 of the 240 strike calls in October. So what do? What can they do to hedge that position? What can they do? Well, the best they can do with the short is what one of the guys said earlier, is to try and buy the contract back as quickly as possible, right? But unlikely that they're going to make any money, okay? Or what about the long side? So don't forget, if I buy the $210 strike calls in December and they short them to me, what are they trying to do? They're probably going to buy the stock at 200, right? They're probably going to buy the stock at 200. But here's the problem. If they buy the stock at 200, they still have to deal with the one contract at the 240 strike that they're now long. Sorry, they have to sell that contract, right? Because they're now long. So they have a long contract at the 240 strike and they're long stock and they've got a covered call position. So they have a covered call position, long stock at 200, short $210 strike calls in December. And then they've got one contract that they're long at the 240 strike. And they have to try and sell it for the same price or higher, right? Okay. The point is that the retail trader Robinhood business is free money, low-hanging fruit, easy business, stupidest clients ever for the market maker, dumb money. You might as well go round to the market maker's office at the beginning of the year, January 1st, and just write them a check. What we do is the opposite, right? We're doing what the market maker wants to do and dumping a position on them that they don't want to have. So we're basically the annoying client. We're the annoying client. So when we look at this question here, what is the best way to create wealth in options trading? The best way to create wealth in options trading is to have great ideas and trade directionally, but dump the bad positions on the market so you can have the good position. So it's about learning how to generate awesome trading structures where you have the probabilities in your favor and the market has the probabilities against them to make money out of the position. Okay. Now, what's interesting about that, we get the agnostic, the risk profile of that trade. We get the agnostic setup. But what happens on the other side? On the other side, they're not agnostic. They really care about what happens. They really care about what the stock's going to do, right? We don't care between now and October. They need it to go up, right? They absolutely need it to. They need to buy stock and they need it to go above 240 because they're now long that option at 240, right? In October. So we're dumping a bad position on the market, and the market makers hate it. They hate us. So when 1,000 guys on Robinhood show up and they buy a 20% out the money